Watch this short video on how modern business and economics differs from before.
Before a company can calculate a return on investment, it has to build something. The global economy is anchored by sheer physical force: manufacturing lines, logistics networks, and heavy machinery converting raw materials into output. Traditional economic theory often treated a business as a single, unified entity. In those early models, capital flowed perfectly through a company, and markets operated without friction. Modern corporate finance requires a different approach. To analyze a company today, we divide it into two distinct halves: the physical operations that produce goods and services, which we call the real economy, and the market instruments used to fund them, known as the financial sector. Despite this complex split between the factory floor and the balance sheet, the executive managing the firm has exactly one primary directive. That directive is to maximize value for the owners of the company. In modern finance, these owners are called shareholders. Every decision made inside the firm is measured against its ability to increase the wealth of this specific group. Achieving that goal is difficult. The financial manager must navigate the highly volatile space where the physical reality of production collides with the abstract calculations of the digital trading desk. Relying on outdated models of a unified, frictionless firm invites catastrophic failure. A modern executive has to master the boundary between the real and financial economies to ensure the company survives and shareholder value is protected. We start on the physical side of the boundary. A company requires infrastructure to operate, and acquiring that infrastructure is the first step in capital allocation. When a firm deploys capital to expand production, like purchasing a brand new heavy industrial steel facility, it is investing in real assets. These are the tangible physical properties and equipment required to produce goods. A firm does not acquire real assets for their own sake. The sole reason a company invests in heavy machinery or physical real estate is to generate a measurable return through operational output. As the factory produces goods and sells them to the market, customer payments and sales revenues flow back into the company's bank accounts. This movement of money into the firm is called an inflow. To determine if a physical operation is viable, financial managers track the total inflow generated by a factory against the initial cost required to build it. Scaling up production and accumulating impressive physical assets serves no strategic purpose if the math doesn't work. A firm must have the financial mechanisms in place to guarantee that its physical operations generate a net positive flow of capital back to the shareholders.
Now, based on the video and your overall knowledge of business and financials, complete the following quick quiz.